Can the PNB MetLife Mera wealth plan help you achieve financial growth and lifelong financial security? Let us find out in an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is PNB MetLife Mera Wealth Plan is about. So, this is an individual unit-linked non-participating life insurance plan. And some of the key features of this policy are you have the choice to choose between two plan options, Premier or online, and you can also select your preferred premium payment term like single pay, 5 years pay, 10 years pay or regular pay. You can also pick from two available investment strategies that suit your financial needs. And you can receive loyalty additions every year starting from the end of the sixth policy year until maturity, which is applicable for both the premier and online options. And you can also opt for a lump sum payout at maturity or choose structured payouts. It's up to you. And in case of an untimely demise of the policyholder, the nominee will receive the higher of the sum assured or the fund value as the death benefit. So now let's take a look at the benefits available under this plan. So first, let's take a look at the maturity benefit. So if the policyholder survives till the end of the policy term, then the maturity benefit is payable, which is equal to the total fund value as on the maturity date. So you will have the option to receive your maturity benefit as a lump sum or as a structured payout through the settlement option. And under death benefit, it is given to the nominee or the legal heir in the unfortunate event of the death of the life assured. So out of these three options, you can see on the screen whichever is highest at the time of death of the policyholder, that will be given as a death benefit. So it can either be the fund value or the basic sum assured, which is less all partial withdrawal made during the 2-year period immediately preceding the date of death of the insured, or 105% of the total premium paid excluding partial withdrawal made during the 2-year period immediately preceding the date of death of the sum insured. And this policy also has loyalty additions which will be allocated at the end of every policy year starting from the end of the 6th policy year. So these are some of the benefits under this policy. Now let us take a look at the 12 fund options available under this plan, which are Protector 2 Fund, Preserver 2 Fund, Balancer 2 Fund, Multiplier 3, Liquid Fund, Flexi Cap Fund, Mid Cap Fund, Premier Multi Cap Fund, Virtues 2 Fund, Crest Thematic Fund, Small Cap Fund and Bharat Manufacturing Fund. And all these funds are categorized based on the allocation they have to equity, debt or money market, and also according to the risk profile they have, which can be very low risk or it can also go up to very high risk. So it depends on these factors. This fund are categorized into different categories. So you can choose the fund options based on your risk profile and what kind of allocation you want to give to your investment portfolio. And there are two investment strategies in this fund. Number one is a self-managed option. So this option enables you to manage your investment actively, and under this option you can invest your premium among the 12 available funds in proportion of your choice, which will be subjected to a minimum of 20% in each fund. And another strategy is the systematic transfer strategy. This strategy helps safeguard your wealth against market volatility and is available only if you have opted for a regular pay or limited pay policy with annual frequency as the premium payment mode. This strategy ensures a gradual exposure to equity from debt in a phased manner through equal installments over 12 months. So all installment premium will be invested in the Protector 2 Fund, which is a debt-oriented fund, and this amount will be systematically transferred to the Flexi Cap Fund, equity-oriented fund over the 12-month policy period. Now let's take a look at the various charges under this plan. Number one is the mortality charge, which will be based on the age of the life insured, the rate as per the mortality charge table, the option applicable, and also the applicable sum at risk. So all these factors will depend on what kind of charges they will charge for you. And another is the premium allocation charge. These are expressed as a percentage of the premium and are levied during the premium payment term only. So these charges are not applicable if you have chosen the online mode. So premium allocation charge is only applicable to the premium mode only. So it is deducted from the premium amount at the time of premium payment. Next is the policy administration charge, which will be levied every month throughout the policy term, and it will differ based on the plan option you have chosen. And there is also something called fund management charge, which they charge for managing your fund, and the charges will also vary based on what kind of fund you have chosen. So it will vary from 0.50% to 1.25%. And there are also discontinuance charges. The discontinuance charges are expressed either as a percentage of the fund value or as a percentage of the annualized premium or single premium. So it depends on the premium amount here of discontinuance and the premium paying term. So over time, what happened is these fees associated with this plan are relatively high compared to other market-linked investments. So like premium allocation charge, policy administration fee, and discontinuance charge act as additional overhead for investors. Over time, these costs can substantially reduce your overall returns. So let us now take a look at the advantages of this policy. Number one advantage is that you can change the allocation of your future premium with premium redirection. You can also switch between available segregated fund options either partially or fully. Partial withdrawals are allowed only after the lock-in period of 5 policy years or when the life assured reaches the 18 years of age, whichever is later. Now, if you take a look at the disadvantages of investing in this policy, that will be the policy loans are not available within this plan, top-up premiums are not permitted, the policy comes with a 5-year lock-in period, only the net premium after deducting applicable charges is invested. So the life cover offered under this plan is inadequate. So these are also some of the potential risks you might be taking while choosing to invest in this policy. Now, as we have a basic understanding of this policy, let us estimate the potential return, which is essential when assessing a market-linked product. So what we are going to do is we are going to calculate the IRR, the internal rate of return of this policy based on the figures given from the policy brochure just to get sense of what might be the potential return of this policy. So let's assume a 40-year-old male purchases this policy with a sum assured of 50 lakhs. So the policy term is 20 years with a premium payment term of 10 years and an annual premium of 5 lakh rupees, and the policyholder has chosen the premier plan option. So the fund value becomes accessible at the end of the policy term provided all premiums are paid on time. So the policy brochure here represents potential returns based on assumed investment rate of 4% and 8% for worst and best case scenario respectively. These returns are not guaranteed in any way and don't represent the maximum or minimum you may earn. These are just for example purpose. So as you can see, at 4% return, the estimated fund value is 76.41 lakhs, resulting in an IRR of 2.75% as per the PNB MetLife Mera Wealth Plan maturity calculator, which is lower than the interest rate typically offered by savings account. So if you have not invested your money anywhere and took this kind of risk and invested for such a long time, you would have still gotten a similar return just if you have kept your money in a savings bank account. So what is the unique value this policy is adding? Okay, this is fine. This is for best case scenario, right? What is the result for a best case scenario at 8% return? So the projected fund value is 1.39 crore, which gives us an IRR of 6.72% as per the PNB MetLife Mera Wealth Plan maturity calculator, comparable to or sometimes even lower than bank fixed deposit rate. So this is only giving us a typical debt fund return. So but we are taking here risk and it's not giving us the risk adjusted return here. So this plan might be a long term investment over 20 years. The returns are not keeping a pace with inflation. So as a result, investing in this plan may fall short of meeting the inflated cost associated with your financial goals. We can see that this policy is not giving us the desired outcome we want. So what we are going to do is we are going to compare this policy with other alternative investment strategy, like we are going to separate insurance and investment from an investment and then invest to see if we can get better returns from that. So let us for an example assume that a pure term life insurance policy with a sum assured of 50 lakhs cost an annual premium of 18,900 for a policy term of 20 years and a 10-year premium payment period. This leaves us with 4,81,100 rupees per year available for investment, which can be directed based on our risk preference. So if you're a low risk investor, you might opt for debt instrument like the Public Provident Fund PPF, which is a government backed product offering you guaranteed returns, and it also has tax benefits under Section 80. While if you are a higher risk investor, you may choose equity instruments such as the equity equity linked savings scheme ELSS, which also has tax benefits. And if you take a look at its track record, you can see that by investing in it consistently for 7 to 10 years, it can give you average 12% or even more than in some instances. So in this scenario, we are going to consider both PPF and ELSS with a combination of term insurance as investment option just to see its potential returns. So as you can see, the PPF account requires a minimum annual contribution of 500 rupees for 15 years. But since the premium payment term is for 10 years, adjustments are made for the remaining year. Also, while PPF has an annual limit of 1.5 lakh, the excess amount is negligible for example purpose. So the final maturity value of the PPF account is 1.42 crore with an IRR of 6.84%, similar to the 8% return scenario of the PNB MetLife Mera wealth plan. However, as a debt instrument, PPF delivers better returns than the market-linked ULIP. And if you take a look at the ELSS investment, you can see the pre-tax maturity value is 2.93 crores. After factoring the capital gains tax, final maturity value is 2.63 crores, yielding a post-tax IRR of 11.74%. These returns significantly outperform those of the PNB MetLife Mera wealth plan, aiding in wealth accumulation and accelerating your investment growth trajectory. What is the final verdict on PNB MetLife Mera wealth plan? Is it worth investing or not? As you can see, this is a traditional ULIP that combines disciplined market investment with life coverage. However, investors willing to take the high risk associated with market-linked products typically expect inflation-beating returns over the long term. But unfortunately, this plan lacks the ability to generate alpha, meaning the risk and return are not well balanced. So while the plan is marketed as a wealth building tool, a closer analysis reveals that it is relatively giving you lower returns, insufficient sum assured, and limited access to your fund, which makes it an unsuitable option for those aiming to build wealth. And also, this policy has a high agent commission. So what you can do instead is you can separate insurance and investment and secure an adequate life insurance like a pure term insurance policy, which you can get for higher coverage even at affordable premium, which is crucial to protect your family's financial future. And instead of relying on this ULIP, it's better to focus on building a well-diversified investment portfolio that aligns with your financial goals and risk tolerance and gives you inflation-beating returns in the long run.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.